Imagine being able to strategically grow your wealth while enjoying a steady stream of passive income. Well, today is your lucky day. In this video, we'll explore a fascinating showdown between two titans of dividend investing, Dividend Aristocrats and Dividend Kings. We will see the key differences, benefits, and potential drawbacks of these prestigious investment strategies, and later on the video we'll also talk about the factors you need to consider when choosing the investment strategy that will fit your needs. So, make sure to watch the video until the end, and remember to hit that subscribe button and click the bell icon so you never miss an opportunity to enhance your financial knowledge. Dividend Aristocrats are companies that have consistently increased their dividend payments for at least 25 consecutive years. These companies are known for their remarkable reliability and stability, making them attractive sources of income for investors, especially during times of market volatility. What sets Dividend Aristocrats apart are their high-quality businesses, robust balance sheets, and competitive advantages. Dividend Aristocrats offer a steady and growing stream of income. This can help investors meet their financial goals and provide a hedge against inflation. They also tend to outperform the broader market over the long term. Their ability to generate consistent earnings and cash flows, even in different economic conditions, has proven to be a winning strategy for investors. And they typically offer higher dividend yields than the average S&P 500 stock. On the other side, these companies may have lower growth potential compared to other stocks. They tend to reinvest less of their earnings into expanding their businesses or pursuing new opportunities. And they may face competitive pressures or disruption from new entrants or technologies that could affect their market share or profitability. These stocks may have higher valuation multiples. Due to their reputation and track record, they are often priced at a premium. And it's important to note that Dividend Aristocrats may cut or suspend their dividends in times of financial distress or regulatory changes. This could potentially impact their share price and investor confidence. Dividend Kings are truly exceptional companies with a track record that speaks volumes. These are companies that have achieved an astonishing feat, increasing their dividend payments for at least 50 consecutive years. Such an achievement demonstrates the immense strength, stability, and profitability of these businesses over the long term. In fact, only a select few dozen companies worldwide can proudly claim the title of Dividend King. One key characteristic of Dividend Kings is their operation in mature and stable industries. These industries, such as consumer goods, utilities, industrials, and healthcare, provide Dividend Kings with predictable and consistent cash flows. This enables them to not only pay dividends but also grow them over time. Furthermore, Dividend Kings possess strong competitive advantages, including brand recognition, loyal customer bases, economies of scale, and market leadership. In addition to that, these kind of stocks offer reliable and growing income streams that can help investors achieve their financial goals. Over the long run, Dividend Kings tend to outperform the market, benefiting from the power of compounding returns. Additionally, Dividend Kings exhibit lower volatility and risk compared to the average stock. Their resilience and adaptability have been tested and proven through various economic cycles and crises. However, it's important to consider potential drawbacks or considerations when investing in Dividend Kings. Firstly, they may not offer very high dividend yields as their share prices tend to appreciate over time. For example, as of March 29, 2023, the average dividend yield of the 48 Dividend Kings was 2.6%, lower than the S&P 500's yield of 3.1%. Secondly, maintaining their impressive dividend growth streaks can present challenges for Dividend Kings. They may face competitive pressures, regulatory changes, technological disruptions, or other unforeseen events that could impact their earnings and cash flows. Lastly, Dividend Kings may lack diversification across different sectors or geographies, with most of them based in the US and concentrated in a few industries. This concentration could expose them to sector-specific or country-specific risks, influencing their performance. One key difference between the two groups is their inclusion criteria. Dividend Aristocrats must be part of the S&P 500 index, making them larger and more liquid companies compared to Dividend Kings, which can include smaller or lesser-known firms. Dividend Aristocrats also have specific size and liquidity requirements, while Dividend Kings only need the 50-year dividend growth streak. The impact of investing in Dividend Aristocrats or Dividend Kings on a portfolio depends on several factors, such as the investor's risk tolerance, time horizon, and investment objectives. Generally speaking, investing in either group can provide a steady stream of income and capital appreciation over the long term, as both groups have outperformed the broader market in terms of total returns. For example, according to the Motley Fool, a hypothetical portfolio that invested $10,000 in the S&P 500 index at the end of 1987 would have grown to almost $1.4 million by the end of 2017, compounding at an annual rate of 10.2%. By contrast, a hypothetical portfolio that invested $10,000 in the Dividend Kings at the end of 1987 would have grown to nearly $3.2 million by the end of 2017, compounding at an annual rate of 13.8%. However, there are also some trade-offs and risks involved in choosing one strategy over the other. For instance, investing in Dividend Aristocrats may offer more diversification and liquidity than investing in Dividend Kings, as the former group consists of 65 companies across 11 sectors, while the latter group consists of only 48 companies across 9 sectors. Moreover, investing in Dividend Aristocrats may provide more exposure to growth-oriented sectors such as technology and healthcare, while investing in Dividend Kings may provide more exposure to defensive sectors such as utilities and consumer staples. On the other hand, investing in Dividend Kings may offer more stability and consistency than investing in Dividend Aristocrats, as the former group has demonstrated a longer and stronger track record of dividend increases than the latter group. Furthermore, investing in Dividend Kings may reduce the risk of dividend cuts or eliminations, which can negatively affect a portfolio's income and value. In conclusion, both Dividend Aristocrats and Dividend Kings offer attractive opportunities for investors seeking reliable income and potential capital appreciation. The impact of investing in either group on a portfolio depends on individual factors such as risk tolerance, time horizon, and investment objectives. Both Dividend Aristocrats and Dividend Kings have historically outperformed the broader market in terms of total returns, generating significant wealth for investors over the long term. Ultimately, the choice between Dividend Aristocrats and Dividend Kings should align with an investor's specific goals and preferences. A balanced approach might involve combining investments from both groups to benefit from the strengths of each. As with any investment decision, thorough research and analysis of individual companies within these groups is crucial for making informed choices. Remember, investing in dividend-paying stocks requires a long-term perspective and careful consideration of one's financial circumstances. And before making any investment decisions, it's highly recommended to consult with a financial advisor.